So when we spoke before, you were talking about the entries and certain things you look for when you're going in for the entries. So now
Yes.
I want to let me explain something to you first. Just let me take my writing tool. Let's explain something. So when you're looking for entries, or the way I look for entries, there's certain things I'm paying attention to. Let me use a different color. So there's certain things I'm paying attention to. First, before you talk about the entries, you need to have like this. The entry is the last part of your system. Yeah. So let's say I'm using psychological levels, for example, like this, right?
Okay.
This is what I do, and I'm looking at price movement from one psychological level to the next, for example. And if this is psychological number one, the level number one, and if this is psychological level number two, and I'm watching price moving to the upside, like this.
Okay.
So the psychological level on its own, it's one principle. The trend line between the psychological levels, or between psychological levels, it's another principle. So you see, the system starts building up from there. So you have a psychological level, principle number one. You have a trend line, principle number two. And you just have price making higher highs and higher lows. That is already the third principle, because right now you're looking at market structure, right?
Okay.
So if you understand where price is going to from one cycle level, and this is just like the system I'm doing, your system might be different. Again, you don't have to do my system, but I just want to show you how I look at it, and then we can narrow it to the way you're looking at your charts. So if you have the first principle, the second principle, and just the market structure thing, the point, so let's say you're anticipating a reversal at this point where price has to drop to the downside. The entry is always the last piece of the puzzle. The bulk of the work is done once price starts moving from here going to the upside. So the point where you actually place the buy or the sell, that's the last part. And I like telling people that's the least of your concern, the entry. Majority of the work has to come before the entry. The entry is just the final part. Sometimes you might even miss the entry, like miss the sniper entry, and you just get a flat entry, but you're still good. You're still in that trade, and the trade is still running. So look at this. Just look at the principle like this. If price is moving from one cycle level to the next cycle level, and you're looking at the structure, you're looking at the trend line, already you can start telling yourself, if you get, let's say, a violation of this trend line, so let's say you get a break of this trend line,
Okay.
now you're like, okay, I see what's happening, because price has told me already we was moving to the upside. So if I'm getting a break already, I need to prepare to look for entries, right? So what are the kind of entries you can look at? I'll show you a very simple one. It's just a price action way of looking at the charts. So let's say you look at price moving to the upside. Price is making higher highs and higher lows, correct? Price is making higher highs and higher lows, and around this area you see a different. So let's say we zoom into an area like this, you see price pulling back, and there's an inability of a price to make a high. Now you have to start questioning the structure move right here. So you're looking at this entire move moving to the upside. So every time you had a pullback, the highs were taken out. Every time you had a pullback, the highs were taken out. Every time you have a pullback, the highs were taken out. And this is just you looking like price action, like what was price telling me, correct? Every time you have a pullback, you see price taken out, and this time you get a pullback and the price or the highs, yeah, you couldn't take out the highs. So that already can be your first signal, like, okay, cool, for sell. But at this point you're not selling. That can be your first signal for the sell, right? Now when you see something like this, another thing you can do is you wait for the sellers to show you that they are ready to sell. So you might see sellers coming in like this. Now that's an indication that the sellers are interested in taking prices to the downside. Now this is still not a confirmation. this has still not, like, this is not a confirmation for you to sell, right? So you can wait again to see the buyers attempting.
Retest.
Or a retest, you can call it a retest. The point where these buyers fail to make or to take prices again to the upside, now your confidence is increasing. So let's say at this point you're almost around 60%. You have a 60% chance of succeeding in this position. Now another beautiful thing you can wait for is, let's say, consolidation.
Okay.
So why are you waiting for all these things? Why is it not conducive for you to go in here? So let's say you had these sell positions right here. So you saw this inability right here. So normally your structure thing had to be a move like this, right? So you had to take your sells like this, normally from an area like this. So the question is, why is it not good for you to take those entries here? Why do you wait for all this gymnastic? Like, why are you waiting for price to do all these things? It's simple, because if you can read the exhaustion from the buyers, then you can see when the sellers are ready to come in. So a very simple model is go off of the price action thing. Go off of price action. Let the candlesticks tell you when the buyers are exhausted. And it's very easy. So I'll clean this again and I'll show you. Let's take out
I have a
everything.
question before you clean it.
Okay, hold on. Yeah.
Okay, so my question is, like, this high highs, it has to be on which time frame? Because of course I know that 5 minutes, 15 might not be okay, or is that, what time frame are you looking at?
Alright, cool. Before, so it's simple. So what I normally do is I have 4 time frames.
Okay.
So I have 4 time frames I work with. So this is how I look at my chart. If you've seen the way I do the market focus thing, I always talk about 4 time frames, right? So for example, I have the daily time frame. I look at the overall structure from the daily time frame, the bigger picture, like what's price actually doing from this time frame. That's the first thing. Then I have the 8-hour time frame. That's the next time frame for me. And then I have the 4-hour time frame, and then I have the 1-hour time frame. And I'll show you this on the charts. It's very important. So if I have a structure move on the daily time frame, and if I can tell the daily time frame is moving to the upside, right? So if I can tell the daily time frame is moving to the upside, it might be difficult for me to see the structural move on the daily time frame. Let's say the details of this move on the daily time frame. It might be difficult for me to see even entries on the daily time frame. So now I have to step down to, let's say, the 8-hour time frame, the 4-hour, and then the hourly. The hourly time frame is my entry time frame. So the reason I use the hourly time frame as the entry time frame is because on this time frame you can actually see. So if you see the move on the daily time frame, which is going to the upside, if you have pullbacks coming in, so you're looking for the pullbacks to do a continuation move, on the daily time frame it might be 1 or 2 candles, or let's say 3 candles like this. But on the hourly time frame, it's going to give you a downtrend, and you might see some consolidation, some slow movement. Then you can look at this to the upside. All right, let me show you something. Let me clean this and show you, like on the gold chart, for example. Let's look at gold. So let's look at gold real quick. XAU, USD, let's see. Okay, so this is the move thing I was looking at. For example, why do I have this?
From your chart, how do we know the bullish and the bearish candles?
Oh, that's something. I don't use different candlesticks like the color. I just use one candle because the way I trade now is different from when I started. I don't even need to, because I'm trading off of prices, so I don't really care how the color doesn't affect me.
Okay, interesting.
Yeah. I don't look at. So let's start from the daily, for example, and I'll come back to. I'll answer that again. I'll make it a little bit clearer to you. So let's put something like this. Let's do 4. Yep, let's do 4. Let's see. I'll clear everything out. Just hold on, let me clean this so we have a clean chart to work with. Let's see. Yeah. Alright, cool. So look at this. Look at this move. I'll put this on the daily. You see gold on the daily time frame, right? I'll put this on the 8-hour time frame. So I just want to show you like how all these 4 time frames can play, and then how you can narrow it down to the hourly and what you'll be looking at on the hourly time frame. Cool. So we have something like this. Alright, cool. So look at this structure thing on the daily time frame. So you can see this massive move to the upside on the daily time frame. You see something like a consolidation here.
Solution.
Do you accept? Does this make sense?
Yeah. Yes.
Alright, cool. Let's clean this and then we'll zoom in a little bit deeper. So and notice I haven't even put like the trend lines and the psychological levels they will normally do. I haven't put all those things, but let's zoom into an area like this. Let's zoom into this area on the daily time frame. So you look at this move on the daily time frame, and let's say you was anticipating this movement to the upside, correct? This was anticipation. We was anticipating the movement to the upside. When you look at the move coming down on the daily time frame, you have the first candle, you have the second candle. So you're looking at this candle. So you have 1, 2, 3, 4, 5, and maybe 6. So everything is just shooting to the downside, correct?
Yes.
Pay attention to how this is going to reflect on different time frames. So if you pay attention to this area right here and you start stepping down to lower time frames, so now on the 8-hour time frame, see what happens. The same piece of price action on the 8-hour time frame, it gives you a low, there's a pullback. Price makes a low, there's a pullback. Price gives you an impulsive move, correct? Oh, hold on. I'm looking at different pairs. Hold on. So I need to put the same pair. Symbol has to be the same. Yep. Yeah. That was a different pair. Sorry. So it has to be gold on all these charts. Alright, cool. I'll take it one more time. So you look at this movement. 1, 2, 3, 4, 5, 6. So you're looking at the movement from here to here. When you step down to different time frames, it starts becoming clearer. So on the 8-hour time frame, you have a push down, there's a slight impulse to the upside. There's a push, there's a slight impulse, the correction thing, there's a move down, another correction, then there's an impulsive move, there's somewhat of a correction. So if I ask you, can you see the corrections on the 8-hour time frame easily, or is it difficult to see it?
It's easy for me.
It's easy for you, okay.
Yes.
Isa, is it easy as well? Yes, yeah.
Yeah, very, very easy.
Okay, it's very easy. Alright, cool. Now
Yes,
let's
sir.
look at it on, let's say, the 4-hour time frame is the same thing from here to here. Now, when you compare the pullbacks on the 4-hour time frame and the pullbacks on the 8-hour time frame, which one gives you more clarity?
The 4 hours.
The 4 hours. Alright, cool. Now bring in the hourly time frame.
It's even better.
The hourly time frame is even better. So now the question that you was asking me, Ben, the question you was asking me about what time frame do I get those entries from? Now it depends on what time frame is it, like what's your highest time frame. So here's my principle. I have something called the principle of 4. So at every given time, I need to look at 4 time frames to make an analysis or to come up with a bias up until the point where I take the entries. And the starting one for me is always a daily time frame. So I always start on this time frame. And then I move to this time frame just so I can see the structure I'm trying to play with. So as I start moving to different time frames, so as I do the daily, the 8 hours, once I do the 4-hour time frame, once I step down to the hourly time frame, now look at this structure move on the hourly time frame, and if you compare it to what you're looking at on the daily time frame, now it's like this, the story becomes clearer on the hourly time frame. And so the last time frame, and that's why I use 4 time frames, because if you scale down to the lowest time frame amongst your 4 time frames, you'll see the structure playing out completely up until the point where there is that inability for that price to move again. And at that point, you start looking for those buys. I don't know if it's making sense.
Yes,
Yes, it
very,
is.
very, very, very clear.
Okay, cool. So look at this. Now let's look at something simple. On this very play that I was looking at, and I took this gold position. So let's look at something simple on here. So still going off of what Ben was asking. I was looking for buys once we had this movement to the downside like this, but there was an overall structure thing I was playing with, first of all. So I already knew from my highest time frame, which was the daily time frame, that I'm getting ready for the buys. So once I saw these prices coming to the downside, I was looking at these prices as just price pulling back or price just giving me a discount so I can buy from. So as I scaled down to the hourly time frame, pay attention. So every time price made a move to the downside, it took out these lows. Are you seeing it clearly?
Yes.
Okay. Price made a move to the downside, it took out the lows. So I was watching this. Price made another extensive move to the downside, it took out these lows. I kept watching it. There was a pullback thing. So every time the lows get taken out, every time price gets this pullback. Now, price made this bigger move to the downside. So if you look at this entire move to the downside, the biggest sell-off came from this leg, correct?
Yes.
Came from here.
Yes.
So I was looking at this and just price action, Ruben, like just price action, like I saw this massive drop. Yeah, I saw the pullback that came in, but for some reason this was the only time when price found it difficult to make a low. So you should ask yourself certain questions, and this is just price action. Like I'm not even putting levels on this thing. It's just looking at it and understanding and asking myself questions. So look at something. So every time, so you had a minor move to the downside, the lows were taken out. You have a minor move, the lows were taken out. Minor moves, the lows were taken out. It wasn't even taking time, right? But you have a major drop to the downside, and you even get a deeper pullback, and that price found it difficult to take out those lows. So there was a question mark thing for me at this point. There was a question mark, like, why is this happening? Why is it happening? Is this an early indication that the sellers are coming to an end? Because after a move like this, what do you think majority of people looking at this on lower time frame will do? They'll wait for these pullbacks so they can sell.
Yes.
So I'm processing all these things and I'm looking at it just price action. And once I see this inability for these guys to take those sells, I'm like, okay, I see what you're doing. So just give me more, like show me like more signs. Now, you see how price starts turning from there. And every time you get this pullback again, there's still an inability. You get another pullback, there's an inability. So I think I just got in at this point right here. And it's not like I was looking at something too complex. It's just a conviction that I've seen this inability. You see, but I had an overall picture thing from the daily time frame, the 8-hour time frame, the 4-hour time frame, up onto the hourly time frame. So this decision on the hourly time frame was the last decision for me. But I've been cracking my head with the other guys in the group, looking at the bigger picture thing from the daily, the 8 hours, the 4 hours up until this point. And before taking these buys, I attempted the buys, I think at an area around here, somewhere here, and I missed it. So it stopped me out. You see? So sometimes like I have just a 30% win rate thing. So I'm wrong 7%, like I'm 70% of the time. So out of 10 trades, I might take 7 losses before even having 3 wins. But the 3 wins, I try to manage it properly. So majority of the times I'm wrong. especially with a read like this, especially when you're reading price this way. So let me show you something real quick. Let's come back to this piece right here on the hourly time frame, and I'll explain something to you. And again, it's just like the price action thing. So, and this is something I learned some time back. If you consider this entire move to the downside, right, as like and you're trying to gauge the momentum, like how these guys are moving to the downside. So look at something like this. You look at this move to the downside, start comparing the pullbacks. This is something I look at as well. So as price is coming down, compare the pullbacks. Look at the pullback. So here, the first one, you just get like, it's a sharp pullback thing. You're like, okay, cool. With this one, the pullback is different. So it gives you a push. That's different, right? You get another sell-off. How's the pullback? It gives you this, it pulls back, and then it drops. Now, more price action. There's this consolidation. So I was looking at all these things, right? And that's why at this point, once I saw price halting around an area like this, I had my initial buy attempt around an area like this, because I was looking at this. So we had a sharp pullback, we had a drop, we had inability, okay, we had a drop. So once I saw this inability consolidation, I was like, okay, I think these guys are coming to an end at this point. And I didn't use the FIP at this point. I wasn't using anything. It was just price action. What's price telling me? How are these guys selling? Is there a difficulty? So I think I attempted a buys at an area like this. I got stopped out, and then price did its movement again. So I had to wait and see what's happening. Show me more price action. Show me what's happening. So I had to look at my higher time frame again to see the overall structure thing. And then I saw that, all right, cool, there's still a possibility for this thing to sell off lower so I can get a better price. So once we had this massive drop, I was like, okay, cool. Pull back, inability, pull back again, sell, pull back, inability, pull back, inability, pull back, inability. At this point, I'm like, yeah, I'm taking those buys. So my interest is always off of like, let's say the price action thing. I'm looking for this exhaustion. I'm looking for the point where these guys find it more difficult. So if you're trying to sell, you're waiting for the buyers to come in. You're looking for the point where the buyers stop. You're waiting for the sellers to come in. You want to give the buyers another attempt. When the buyers fail, a good thing is like you just waiting for a consolidation, because this thing happens most of the times, especially on lower time frames. So you'll see it here if you step down to like the 5-minute time frame or the 15-minute time frame. So what you see as just a move like this on those lower time frames is like a consolidation thing. So it's like the prices is just finding it difficult, like it's bouncing within that area. So now you're looking for those sells. And if you're looking at the same thing from sellers, you're waiting for sellers to come in. You're waiting for these sellers to find like this inability. You're waiting for buyers to step in. The sellers attempt again, an inability. Then you're looking for the buys. But this takes time for you to practice. It's not something you can just grasp of like that. You cannot grasp. Like it takes time. There's practice. And with the way I do mine, you've seen I'm wrong most of the time. So I've already accepted that's my fate. So I know sometimes I'm going to get it wrong, but when I have it correct, and then I know I just have to hold it a little bit longer. And that's how I look at it. That's one way to look at it. Now, there's many ways you can look at entries. And what I tell people is, don't try to copy my entry or don't copy my way of taking entries. Pick an entry that suits you. So you might come within this entire thing. I'll show you something. So within a move to the upside like this, your entry model could be a simple model. Let's say price is making higher highs, higher lows, higher highs, higher lows, and you see price finding it difficult to make another higher high, right? So you're looking at this pullback. Price is taking out this pullback here. No, let me clean this so it's there. So then let's pull this out like this. So price is moving to the upside. You're trying to build an entry model. Price makes a high. Price pulls back. There's an inability for price to make a high. So This is simple. This is simple. This could be an entry model for you. So you don't want to get an entry here. And you don't want to wait for this to get taken out. So I'll show you two possibilities. One, you can wait for these sellers to take out this area. That is the first. And then they give you a pullback and some kind of a consolidation, or maybe the 5-minute time frame. You look for those sells. That's possibility number one. Possibility number two, you get the same movement to the upside. You see the same inability, but now you're not waiting for this area to get taken out. You're waiting for this area to get taken out. So why are you waiting for this area? So this area, if you wait for this area to get taken out, you might be getting in with an aggressive entry. And why am I saying it's an aggressive entry? Because you had buyers stepping in here. You had buyers stepping in here. You had buyers stepping in here. So these buyers took out these highs. These buyers took out these highs. These buyers took out these highs. But these buyers did not take out these highs. So if you're waiting for this area to get taken out like this, and you're waiting for the pullback to take your entries off of these cells, it might be more risky. Why? Because these guys have not shown you the ability to take out this area. So when you look at it from a bigger picture thing, this movement from here to here is still in the buyer's territory. And unless they take out this guy, unless they sell and take out this guy, you run the risk of this price consolidating and making new highs.
Okay.
And that's how you can get stopped out. So the same structure, one entry can be aggressive, one entry can be very conservative. So you could wait for this area to get taken out, so you get now more confirmation if you wait for this area to get taken out. So you wait for this sell-off to happen like this, you take out this area, you give the buyers another attempt. Let the buyers try again. So the fact that you've taken out this lows or this structure right here, it doesn't mean it's completely over. Let the buyers come back. So when the buyers come back, there's something you can look for. They always struggle. So if you had prices moving to the upside, making higher highs and higher lows, compare this movement, compare this movement, compare this movement to this movement. This is always going to struggle to come back. When you see the price struggling, then you know there's a problem. The guys who did the buys from here, they might have taken out their profits at an area like this, and that's why you're having these difficulties for prices to go to the upside. And eventually you see this movement fading out. You see it fading out. Then you can sell. That's one way to look at it. So that's how you can build an entry model. I'll show you again another thing. Still on this one, right? Still on this one. I'll show you something real quick. So let's say you look at the same structure thing, but this time you decide to put, let's say, a fib level like this. And let's edit this fib level and put, let's see, that's 50, and you can do 6. I haven't used this in a long time, so let's put 50, 61.8. I know this level, and let's say, what is there, 76?
78 also.
78, I think. All right, let's just use 50 and 61.8, correct?
Okay.
So let's use this one. This is a very popular one now. Cool. So you're looking at this move from here. So let's say you're looking at this entire move from here. So you're looking at this movement from here to here, and you're waiting for the pullback to, let's say, the 50% retracement or the 61.8 retracement. So as price comes to this area, the same principle I showed you, price action, but this time you're combining it with a fib level. So as the movement starts coming back, as you see this slow movement to the upside, now you have your fib level around here, and you're waiting for price to show you that inability or that consolidation within this 50 and 61.8 level. That's added confluence. Now you can use something like that. And then Ruben, you told me something about your SMC thing as well, right? So you can wait for the same thing within this area and you look for, let's say, an order block. So there's just many ways you can look at it. But with me, I always go for simplicity. When I have my basic concepts, I have my psych levels, I have my trend lines. Those are the two major concepts I'm using. All I'm waiting for is like my brain and my eyes to tell me, go in. So I don't use the other blocks. I don't use the FIP levels again. I just watch price, the way it's moving. And then I can tell it's like a feel at some point. I'm like, this is the best discount you've given me. So I'm looking at it as discounts. So I'm looking at it, I'm comparing the structure from the 8 hours, the 4 hours, and then back to the hourly. When I see this inability, this difficulty, this struggle, I know it's almost the right time to go in. Yeah, I don't know if it makes sense.
Very well.
Yeah. I think Ruben's connection had a problem. So if you look at something like this, that's how I'll look at the that's how I'll look at the entries. So Ruben had just the issues with the entries, and yeah, so I'll take out this time to explain something like this. So his trading system is quite different from mine. Ruben, are you there?
Yeah, my laptop went off, so I'm using my phone.
Okay, cool. But up until this point, does it make sense?
Yes, where you stopped was when you're using FIB. That's the last in my head. Can you go through it again?
All right, cool. Let me take out the FIB real quick. So I'll take out this FIB level. So let's take out the FIB. And I'll expand this. Let's see. But you understood the structure thing I was showing you here, right?
Yes.
All right, cool. So I was saying, if you find it difficult to go in with the price action, because sometimes going in with this price action system I just showed you, or this approach, you need a lot of practice, and it's very subjective. So what I'll look at as a consolidation after the struggle, you might not consider it that way. So now if you want to make it easy for you, you can use things like the FIB levels as well. So if you bring a FIB from your entry point, from this highest point to where this price made this low, and you do something like this, so within the same structure thing, so while you're waiting for these prices to pull back and give you this inability, so while you're waiting for these prices to pull back and give you that inability, you can wait for that pullback and that inability around the 50 and the 61.8 level. Once you see price struggling around that area, then it comes in as an added confluence thing for you, and then you're looking for those sales. But
okay, makes
the
sense.
entry model or the entry tactic or the system for your entries is something you need to be comfortable with, and then you test it. And once you test it, you give it time. Like, let everything play out. It's probabilistic at that point. Don't look for something that gives you 100% win rate at that point of entry. Start with the conservative entry I've shown you. So you're looking at something like this right here. So you can look at this piece right here. This is an aggressive entry. You can take this aggressive entries, or you wait for this area to get taken out. You wait for this struggle thing to come back, the consolidation, before you sell. This is a more conservative entry right here. This one is very aggressive because you run the risk of prices continuing its move to the upside. So you can test this too and tell yourself which one is better for you. You see? Yeah. So with me, it's all about pattern recognition. I'm very good when it comes to pattern recognition. So within this entire move like this, personally, I'll look for a pattern. I'll build a pattern around it, and then I start testing that pattern. So every time price is doing all this crazy stuff, you remember when I always explain, I'm looking for a push to the upside, I'm looking for a consolidation, and I'm looking for the next push. So within this consolidation move, where everybody gets scared and they're walking away, I have a pattern I'm looking at within that move. Like within the noise, there's certain things I'm looking at, so I can take my buys again to the upside. So it can be the same thing for you. So you can look at this piece right here, you look at the buys, you look at all this noise, and you build a pattern around it. And there's something you're looking at, then you can use it as your interest. It could be different from mine, and it's not supposed to be the same with me. But we're trading almost the same structure, but at the point of entry, it's a little bit different. Does it make sense? Yeah.
Very, very well.
Okay. So that's something about the entry. So that was Ruben's question. So Ruben, does it make sense, man?
Yes, it does. This makes sense a lot.
Yeah. But I want you to test it. You need to test your models.
Definitely.
So something I can tell you is you can look at the structure thing. So don't allow, let's say, so what people do is they go through education programs. If you're working with a mentor already, or let's say you have a system you're working with, and the person that showed you the system already shows you an entry model, test the model. But if you don't have a model, you need to build your entry model. Like, you need to build your entry criteria. There's certain things that will make you comfortable taking those positions when you look at it. Now, for somebody who hasn't got any of these strategies or these setups to look at, you can test it. So if you took a mentorship program from somebody, that person must show you their entry criteria. Now you can put those entry criteria on the ground and break it down, pick certain pieces of it and flip it the way you want. That makes it comfortable for you. But don't change the structure move the person has shown you. But at the point of entry, you might tweak it a little bit just to make it more comfortable for you. Yeah.
Okay, cool.
Yeah. So that's something you can look at. And again, there's many ways you can look at it. So within this piece of price action thing right here, let me see if I can show you something. So let's take out a couple of things. Let's see. Hold on. Let's see. Let's take out a couple and I'll show you something. So let me take out this, move right here. Something like this. All right, Ruben, look at this. So you're looking at this move from here to here, correct? So you look at this impulsive move to the upside and you see this price coming back and doing something like this. If you extrapolate this piece from here to here and look at this price action, what this gives here is something like this, right?
Yes.
Is this not what most people say, double top, double bottom?
Double top.
Exactly.
So you see, so you're even coming back to something similar to double top, double bottom. But I don't want you to just say, oh, I'm looking at double tops, double bottoms. No, because then it can become very confusing. So what about this piece right here? Is this not a double top, double bottom? It is. So I don't want you to look at it that way. And that's how I explain to the people. Break that price, like break the price open, that price action, let everything unfold. So it might look like it's a double top, double bottom, but sometimes it's not the way it looks. Yeah, exactly. You might need just this extended moves for the price to play out for you to see everything. Yeah, there's a look-alike, it looks like, but it might not be. Yeah, I've taken positions where price does something like this. It comes back down, it consolidates, and it even takes out these highs like this, and I'm looking for sells. It looks kind of stupid that you're taking sells, that you're taking sells when these highs haven't taken out. Yeah, because at this point everybody's like, all right, cool, we're taking prices to the upside. But then there's another principle, a very simple one. Every time you see price taking out a high, just know you might get an impulsive move to the downside before a continuation to the upside. So it looks like a double top, double bottom thing, but if you're going off of the principles of double top, double bottoms, you don't want this pullback to take out these highs, because if it takes out this high, it's giving you a new structure thing. So you see, yeah. So you have to test it. You have to go in, look at the price action and ask yourself, what am I comfortable with? Like, what makes me less stressful when I'm taking entries? You need to build a setup that works for you. Something, when you see it, it becomes easy. And look for something that is repeatable, something that happens every time. This simple thing I've shown you, it happens every time. If we even start looking at the charts, I can show you this same play, this same setup on the chart. Yeah, you can look at it. Now when you bring the candlesticks and you start looking at it, it's gonna make so much sense. It's gonna make so much sense. A lot. I wish I can show you guys something, but yeah, it's gonna take time. But yeah, of course I need to scroll and start looking at the price, and I also want to show you something else as well. Yeah. So Ruben, that's one step. So that's just the first step, and you have to test these things out, like test it out and see what's happening as well. Yeah. So are you good now? Can I show Issa something? But again,
Yes,
we can always come back to this. And let's say you pick an entry model. Let's say you pick an entry model. Just hit me or like send me a text and we can come on the chat and build something that makes sense. Like, and then we'll test it.
This makes sense and it's very, very logical. So I'll give it a try.
Yeah. All right. Let me show Issa something real quick, and then Issa. So what was your problem thing? Was it with the?
Yeah. Mine is the interval when you are taking the psychological level.
All right, cool. So do you want us to use gold or you want us to use NAS? Or...
Let's use NAS.
All right, let's use NAS. Okay. Yes. So let's look at NAS very quick. Indices. Okay, cool. So I'll start on the daily time frame. So the daily time frame is always the highest time frame thing for me. So when I'm picking these levels, I want to start on the daily time frame. So I want to start on my biggest time frame. Right? I'll explain something to you real quick. Let's do a quick explanation. So Issa, if you go to the marketing in your, let's say you see something for 10,000, you see something for 100,000, and there's something for 1,000,000, and let's just put this in dollars. And you're a business person, and your business capital gives you the opportunity to operate at 100,000 level, right? And the bank tells you, for example, Issa, every time that you're making profit, will give you increment of 100,000. So if you're operating very well, the next time you come to borrow money, they'll give you how much? 200,000, right? And this is your range, 200. If things are going on perfectly fine, the next one is gonna be 300,000. When it's not moving very well, they're gonna drop again to 200,000. If it's not moving well, they'll drop to 100,000. Correct? Now, for somebody who is doing 10,000, he's gonna move to what? 20,000, and maybe 30,000. When it's not going well, he's going to come down to lower ones. Another quick example with this psychological numbers. Just before we plot it, I just want to show you how these things even play a role. So when you go to the marketing, have you seen, let's say you guys have like the shops, like shopping malls, and you go inside and you see prices. They always put those prices at 99.99, 49.99, or 9.99. You know why they put something like this?
Yeah,
just for rounding.
Just for rounding. But psychologically, when you look at 99.99 and you see another price at 100, let's say dollars, you might think you're buying it cheaper. Yeah. It's just the mind. The mind is telling you. Yeah, it's psychological. The mind is telling you, oh, I'm buying this thing very cheap. It's 99.99. I'm looking at 49.99. So I'm buying it at. So you think you're operating at 40, but logically you're still paying 50. Yeah, you think you're doing 9.99. You're paying $10.
5.
You see, so you think you're operating at 9 this. So it's just the psychology around that. So round numbers have a very big influence when it comes. So this is like example number 2. This was example number 1, just the way you operate. Another quick example, if banks are operating, so let's say a bank is trying to do, so let's say the bank in your country is trying to operate with another bank, let's say in Europe, and they're trying to move money across. Is it going to be easy for them to move 100,000, or let's say 925,000 175. If you're doing the accounting and you're trying to balance the books, which one is going to be easy for you?
1 million.
The 1
This
million
one.
is easier.
It's easier that way. So that's how this site.
It's a round number.
Yeah. So you see, you can use these round numbers in almost everything you're doing. So so this is example number 3. Now let's do example number 4. When you go to the market to buy something and you start beating the prices. So let's say you're trying to buy a phone and they tell you that phone costs 10,000, right? So now, Isa, will you tell the person you have 9,125, or you tell the person I have 9,500?
9,005.
9,005. Why? You start rounding it in your brain. And you might say, oh, I have 8,000. So it's difficult for you to say, hey, I have 8,125. It's difficult. You always go for those round numbers. So in every aspect of life, these round numbers is very important, and that's why I use them. So let's clean this now that you know, all right, this is how it comes about. So let's say the first thing is, when I'm looking at the charts and going back to what Ruben was asking me, I'm not putting this candlesticks on the chart. So when I'm plotting my levels, I take out the charts. I don't want to look at it, because what most people do is, let me show you. Let's see. Let's see. Where is this thing? Okay, so this is the chart thing. When I'm plotting these levels, I like to hide it. You see? I'll hide it. I don't want to look at it. So the reason I'm doing this is because I've noticed, like, lots of people, when they're plotting these levels, they'll put a level here, they'll put a level here, and they'll put levels like this. And when they start putting levels like this, you're trading a different concept. This is maybe support and resistance, or supply and demand zones, and it's quite different from just the psychological levels, because now you're becoming very biased by looking at the immediate levels like this. Correct?
Yeah.
So what I do is I take out these levels, I take out the price chart thing, I hide it. So I'm not even looking at it, and I pay attention to this.
You'll be very objective.
Yes, and I pay attention to this part, you see? Because everything happening here is price.
Yes.
Cool. So I'm paying attention now to this price. So with this now, I can take out these levels. I take these levels out, and I'm paying attention to price. So now let's look at this on the daily time frame. So I have this right here. So now when I have my psychological levels on my highest time frame, so let's put something like this. So just as an example, if I have my levels like this, so one psychological level, the next psychological level. So what I like to see within the psychological levels is some price action. Remember, my highest time frame, I plot these levels on the highest time frame, and I'm looking for some piece of price action within that time frame. So the reason I'm doing this is because if you look at this on the daily time frame, price moves in 3 simple ways: higher highs, higher lows, lower lows, lower highs, and a consolidation. Correct? So if I'm able to see something like this, just maybe 1 or 2 movements on the daily time frame, once you step down to like the hourly time frame where you're looking for these entries, or let's say the 8-hour time frame, you start seeing structure moves coming in. You're seeing consolidations, you're seeing all these things. So you start seeing all these crazy moves now, and you can capitalize as these pullbacks are coming in. You can read those pullbacks easily. You can read those pullbacks easily. You can read those pullbacks easily. And that's where you're looking to capitalize on those continuations. And that's why when I look at the psychological level, I want a level that gives me some price action, the daily time frame. Because when you step down to lower time frames, this is what you're seeing. And every pullback, and that entry model I was telling you, when I look at those pullbacks, I'm looking at those like price slowing down, that difficulty, I'm looking for entries. Price slowing down difficulties, I'm looking for entries. And that's why I told you guys, when I'm doing my movement from one side level to the next one, and just the one look at price generally, I'm looking at a move to the upside, pull back, and then move to the upside. Or you get a move to the upside, consolidation, and move to the upside, and maybe a pullback and then move. So that's all when it comes to the structure thing I'm looking at. But on the daily time frame, when I plot this on the daily time frame, I'll show you. So let's put these levels now. Let's do something real quick. So let's put this level. So let's say the round number, so price is currently at 15.648. So let's edit this and put a round number. So let's put 15,000. Correct? So let's put another number. Give me another round number above 15,000.
15,500.
15,500. Okay. Okay, cool. So give me one below.
14,500.
14,500. No, I'll ask you a quick question. How about 14,300?
Yeah, it's also a round number.
Okay, so let's just put it. I just want us to see something, yeah?
Oh,
now let's bring the charts back. So let's bring this chart. So look, this is your daily time frame, right? So let's say you're plotting these levels. Now, so you have 15,500, 15,000, and 14,300. Now, there's one thing you have to start correcting. The distance between one psychological level to the next psychological level has to be the same.
Same. Okay.
You remember when I was, You remember when I told you about if you're a business person and they're giving you increments of 100,000. So if business is moving well, they'll do 200,000.
Also, in the same multiples.
It has to be the same multiples.
Yeah, it has to be.
It has to keep it constant. It's very important. I'll show you. It's a very important thing. So you want the distance between the psychological levels to be the same. So when you look at this, I'm doing 15,000 to 15,500. So this distance, the difference is 500. When you look at this, 15,000, and you're looking at 14,300. So what's the difference here?
700.
700. So it's not the same.
It's not the same.
Okay.
It's not the same. So the price action here is not going to be the same. So you won't have the same price action thing, because I'll show you something I always compare when it comes to the price action. It's not going to be the same thing here. So no, it's not going to be the same. So you're looking at different ranges. So for example, if you buy from here to hold prices to this area and it takes you 2 weeks, because you're using a different scale or a different interval here, this might take you 4 weeks and stuff like that. But you want something that is almost the same, so you can understand it, like the price action within those levels. And if it's taking you longer, you know there's a problem.
Exactly.
All right, cool. So let's clean this. So let's correct these levels first. So the first thing is let's correct the levels. So now you're looking at this. So remember what I told you. On your highest time frame, you want the levels to give you a price action you can work with.
Price action.
Correct? So let's hide this again, and I'll show you. Let's hide this again. I don't want us to plot these levels because we've seen the price action. So let's start with 15,500, and let's do now. No, let's start with 15,000, and I'll take the next one as 16,000, like this.
How do you pop up this drop down for entering the psychological numbers?
I just double click on the. Horizontal line. Yeah. So you can double click on it.
Okay. How did you get the horizontal line?
It's just this tool here.
You take it from the tool.
Here. This area here. Here, horizontal. This one.
Okay.
Horizontal. Yeah. That's the one I'm using. So you can right click on it and go to settings. It's the same thing. Or you just double click real quick. That's the easiest one for me. So let's use 15,000, 16,000. So if I'm using a level below, I'll use 14,000. Correct? That's it. So let's do, I just want to put multiple levels. So let's do, that's 16,000. So I can do 17,000. And let's do one above this. I can do 18,000. So now I'll bring the chart again. And then I ask myself, the interval within this Does it make sense? So if I bring the chart again, and this is what I'm saying right now.
How did you bring the chart back? Sorry, that's not.
Okay, so if you're trying to hide it, you go on the candlestick, you right click, you take hide.
Okay.
So when you hide it,
okay.
Yeah, you look at this eye symbol right here.
Oh, okay. I'll click it. Okay.
It's hidden. So yeah, you just you click on it.
Oh, hide. Okay. Okay.
And it brings the chart again. Right? Okay. Alright, now look at this. Within this piece of price action, right here, all you see is just price moving like this.
Swing move to the upside.
Yeah, but this is what you're looking for. So what I want you to look for is price making some kind of a higher high, higher low. That's price action between
action.
Yeah, that's price action between the levels. Yeah, because if you look at this, it's just a single move, or you can say there's a move, there's a pullback, and this. Yeah, we can use something like that, for example, right?
Yes.
Is it making sense now?
Yes, it does.
Very,
but
very
I have
well.
a question.
Yeah.
How do you determine? Okay, the current price determines where you are going to start from. Correct.
Say that one more time.
If for instance, price of gold is on 2691 today.
Yeah.
So that will not determine where you're going to start your price action for this psychological level from. Correct.
No, look. If I do something like this, so let's take out these levels real quick. And I hide this. I don't even know where gold is currently at.
Okay, doesn't matter. Okay.
Yeah, doesn't matter.
And you want to be very objective.
Yes.
So
I just want to go off of. Yeah, I want to put these levels off of what this price is telling me here. Can you see this?
Because most of what I learned with the charts, people will just be looking at the position where they suppose that resistance. That's what they use.
Yeah. So,
but this one is more objective, and you get it accurate.
Yeah, it's all about the prices. Yeah, I don't want to see the price, because if I see price action, it's easy for me to say.
To influence
you.
It's easy to say there's a psychological level here and here and here. So I don't want to see these things. So I just want to plot them without seeing anything.
Okay.
Yeah, I want my levels to come off of that principle I explained to you. So once I hide this, so let's say I hide this chart like this, and I'll just put this level here. So if I start, for example, I'll take 17. So let's do 17,000. You see? So that's my first level. If I bring another level on top, I'll do 18,000.
Okay. How do you bring the second level on top? Sorry that I'm not used to.
Okay, so I right click.
Okay.
You can clone it. And then you double click.
How do you clone it? How do you clone? Sorry, let me show you.
Okay. Look, I right click.
Okay.
And I clone.
Oh, okay, there's clone.
The next, the next level comes.
Okay.
And then you edit it. You put 18,000.
Okay. Okay.
For example. Or you can do now. Still going off of this psychological level thing. So let's say I'm looking at this thing right here, and now we're on the daily time frame. I'm looking at this. All right, cool. So I'm seeing prices moving from 16. So I have 16, 17, 18. So I'm like, okay, cool. Sometimes I like to do, let's say there is 20,000. So let's say I'll put 20,000, for example. And then let's say I have about 17,000. So I can do 15,000. Right? So I'll do 15,000. So between 15,000 and 20,000, so I can do something like this, and I'll do 10,000. You see? I'll do 10,000.
How do you sorry, I'm asking plenty of questions. How do you determine the intervals?
No, this is it. That's what I'm trying to do right now.
Okay.
Depending on the range, as he said, if you're going to the bank as a businessman, the range of capital you got to operate with. So now we're operating within the range of let's say 50K.
Okay. Yeah. So this is it. This is my range. I'm trying to pick out. So the first thing is just putting these ranges on the chart, just to understand what's happening, right? Just to understand. remember, within these ranges, I want to see some price action.
Some price action.
Because if you're operating, let's say you're doing business at 10,000. If your business is moving, you're buying and exchanging goods, buying and selling, your profits will be going up. You're buying, you're selling. Sometimes business will be slow. Sometimes business will boom. Yes. Sometimes business is going to be slow. Business will boom. So that is it. That's why I want to see this price action.
Yeah.
You see? So on my biggest time frame, I want to see something like this. Now on the biggest time frame, because it's the daily time frame, you won't. So on the daily time frame, you might not see it this clear like this. So you might see something like on your lower time frames. That's why we now bring out that principle. You remember what I showed you before, principle of 4. When you dissect this on lower time frames, like on the hourly time frame, you can see your entry here. That's to buy from and do the continuation thing. All right, cool. So let's continue, right? So let's bring the charts in. Now let's bring the charts in like this. I like this one now. You see, with these levels, this is something I can work with. Can you see the price action on the daily time frame?
Yeah.
Okay. Very clear. So now that is something I can work with. So let's put another level above 20,000. So I'll just put 30,000. So let's do 30,000. That's it. And yeah, right there. So here's a question. Why are you looking at this? Just looking at this, where do you think gold is going to move to next?
NAS.
NAS. 100.
Yeah, sorry.
30,000. That's the next level.
Yeah. So if we find it difficult for these prices to take out this, we're going all the way to this. So once you have this, you've built like this is your thesis right there. This is your foundation.
Sorry, it's still not clear to me. How do you determine this range of 55K that you just used here?
Okay, I'll take it one more time.
Or you could decide to use 2,000 and just 1,000.
No. Take note of the things I've said. The things I said before has to come with this. That's why I did that little gimmick that I was showing you, that little thing. This is a very okay. I'll take it one more time. Can I take out the levels?
You can explain without taking out this chart. I will understand.
Okay, cool. When I'm picking the levels on my highest time frame, I want to see some price action. So if you ask me, so let's put certain levels. So I just want to put certain levels I'm not going to use, right?
Okay.
So this level right here, let's put 20,000. Let's put 21,000, for example.
Okay.
Let's put 21,000. That's fine. Let's put 21,500. 21,500. Cool. So if I use 21,500, right? So let's say this is 20,000. So I can do 20,500 and put another one. So 20,500. All right. So these are other levels, right? At these levels round numbers. 20,500 is a round number. 20,000 is a round number. 21,000 is a round number. 21,500 is a round number. But going off of the way I look at prices and the way I look at my psychological levels, you see this movement right here. It's difficult for me to see the price action on my biggest time frame. It's just so this is just one candle.
Okay.
This is just 2 candles and it has taken out the range thing. For somebody who is scalping, this is going to be good for you. This range is good for you because when you're scalping, you're probably not even looking at the daily time frame. You're looking at lower time frames. Maybe the 4 hour is your highest time frame. So if you look at this same piece of price action on lower time frame, so we're looking at 20,000, 20,500, 21,000. So we're paying attention to this area. So if you look at this on lower time frames, so let's just put this on the 4 hour time frame. For people who are scalping, I think sometimes they're using time frames like the 4 hour time frame and the hourly. So let's bring this to the 4 hour time frame. and sometimes they even using the hourly or use the hourly. Cool. So if you're scalping, this is a good range for you. Why? Because within these levels you have the price action. If the hourly time frame is your highest time frame, sellers pull back, sellers pull back, sellers pull back. So there's this price action between the levels. So somebody who's scalping will look at this on the hourly time frame as the price action, because when you have this price action, you can then do the continuation moves on lower time frames.
Okay.
Does it make sense now? So personally, yes, I'm using the daily time frame. So if I step back on the daily time frame, I need to see the price action as well. So 2500, 21,000, there is no price action thing I can really see within this structure. So those are not the levels.
Okay.
So those are not the levels I want to pay attention to. But I can see the price action from 15,000 to 20,000. You can see this price action. So once you see something like this, it becomes easy now. That's why you see now my other principle thing. I can put a trend line to study and see how price is moving from, one level to the next. So my aim now is to understand this movement, look at this consolidation, look for possibilities to buy. As price keeps moving and as price comes back to the trend line thing, I've explained this as well about trend lines. We cannot do everything today, but I just want to show you the thought process thing behind. So I'm looking for buys within these areas. I'm looking for maybe sells. There's something I explained last time on trend lines, the delivery from one time frame to the next one. So during a period like this, I'm looking for these sells coming back to this area. Once price delivers to this trend line, the pivot point is set. I'm looking for the next swing move. So now if you're walking, so ISA, something like this, if you get an entry here, right? If you get an entry around an area like this, all you have to do is sit
to target the next level.
Just to target the next psychological level. Right? Something like that. And so that's what you're looking at right there. So that's just an example thing. So let's look at this. I think I've explained this already. So what's the last thing I can explain? So we have these levels now. So the next thing I like to do is to study the interval. So going back to what Ruben was asking me, I like to study this interval just to understand what price is doing. So I use this tool called the dead range tool.
So to check how long it took. Okay.
Yeah, to check how long it took. So if it took me from here to here, it took 232 days, right?
Wow.
So it took 232 days, but within these 232 days, trust me, on lower time frames, on the hourly time frames, all these pullbacks, you're looking for buys. All these pullbacks, you're looking for buys. All these pullbacks, you're looking for buys. You're looking for buys. And sometimes you might not have, so sometimes you might take 3 or 4 trades within the entire move, but you understand where the price is going to. So you look at this move from here to here. There is this inability for prices to come back to the downside. Common sense, you're going to this next level. Yeah. So now if I'm doing sells, I know what I'm doing. If I'm doing the buys, I know where I'm headed to. And if you get a good entry around here, you can hold this, and maybe once you do like 8-7%, you close everything, take your profits and walk away. Let the rest to flush out and do this thing while you're resting, and then you're coming back. Or let's say I'll show you something real quick. So let's say hold on. So let's say hold on. So let's say within this area right here, so let's say you did the buys from here, not even here, right? Let's say you got in here. Remember, this is a daily time frame. On the lower time frame, like the hourly, you'll see an entry.
Swing.
Yeah, that's a swing. So let's say you hold these buys. As price is pulling back, you're just moving your stop loss to secure your profit, right? And eventually you see this trend line. So there's a minor trend line. You look at this on the 8 hour, on the hourly, you see this trend line taken out, you can close all your positions here and walk away. And then you have to down. Go on.
Okay. Maybe when finish
scaling in. Yeah. That's why I'm showing you this.
Trailing stop loss.
No, trailing your stop loss is different from scaling.
Different.
So when you trail your stop loss, you're just protecting, you're just locking in profit. Now, with every pullback that comes in, look at this price action. If you step down to the hourly, that guy. Oh, I was on the daily. Hold on, let's see. I want to see this on the hourly. Visibility. So if you step down to the hourly, you're looking at this same price action right here. So for every pullback, so let's say you had an entry here. Your first entry was here, right? Yeah. Your first entry was here, somewhere here. Again, I'm just showing you this. So your first entry was here. And again, you're trying to take these prices all the way to this area right here. For example, that's your entry. So for every pullback that comes in, you need to have, you're not just going in blindly for the scaling. So for every pullback that comes in, you study the price action and you see the area where it's more favorable for you to take the buys again from, correct? And let's say you just add one position here. And sometimes you don't need to scale in like 3, 4, 5, 6 times. If you get one entry, your main entry, and you get another entry, which is a scaling, just sit and walk away. Because the more you scale in and the more you move your stop loss to lock profit, price can reverse and take you out. For example, if you try to scale in around here, and let's say you risk another 1%, and you put in your stop loss here to do the same thing, you might end up losing too much. So you see, with this scaling, it took you out and price continued to move to the upside. So once you have an entry, maybe one scaling is okay. Don't people try to put like too much. Keep it simple. One good entry, maybe one scaling, manage this position as price is moving now to the next psychological level. Now you can put a trend line. Once you see that violation thing, walk away, which happens around here. You walk away. Yeah, but personally for me, once I see this violation, this sales coming, I'm looking for buys again because I'm still heading to the upside thing. Yeah, but it takes time, and sometimes I miss it. Sometimes I'll go in 1, 2, 3 times and I'll miss it. All right, so look at this piece right here. So currently I think we've sat around 20,000. So this is 20,000. I think the levels I'm using on gold might be even different. So let me see, up to 30. So I have to check. I haven't even looked at it. So let me put 25,000. Let's see. Yeah. So I think on gold I'm doing 25,000 and then 30,000. So the next one below this has to be what's that? 15, right? 15. So I'm doing 15, 20, 25, 30. Yeah. So back on the daily time frame, those are the levels I'm looking at. So the position I'm holding, if I'm able to, so the position I'm holding currently on gold, I think I said this during the market focus thing. If gold has to keep moving to the upside, the target thing I'm looking for is 25,000. Can I hold this position all the way to 25,000? It's not easy. It's difficult. It's going to take time. And that's why you study the range. So you have an understanding. Don't take a position and say, oh, I'm holding it to the next psychological level. This is the reason why you studied this thing. So look at this one. It took 232 days for price to travel from here to here. I don't want to hold my positions for 232 days. Right? So on gold, sorry, this is NAS. Man, I kept coming back and forth. So on gold, for example, I had my entries around, but it's okay. I had my entries and I just want to cap it on the highs, not even this level. And where price is currently at, if I can just take it to the next highs, That's almost 1:9, 1:10 or something.
Yeah, like on that goal, on your analysis,
this is
you
nice.
made mention of I watched your analysis that of yesterday. You made mention of saying you're watching, you're going to keep an eye on the XY.
I use the DXY.
I don't know.
They are inversely related.
Yeah.
They are inversely relating, but sometimes I will see the DXY we keep going and gold will keep going up.
Yeah. That's because
sometimes correlation.
God is a safe God is a safe haven. So you can read about it online. God is a safe haven. So for certain pairs, and when you look at correlations don't work 100% of the time. There's certain times when the DXY is moving to the upside and gold is moving to the upside. That like there's political reasons for that. You can have just for example, let's say you had investors in the West Coast in California. Now there's a fire in California. This fire is catching wildly in California. So business people in that area will move their money from their investments around there and put, let's say, in gold. You see, but when you look at the DXY is moving to the upside. So you should normally expect gold to be dropping. But incidents like this can influence this to cause those prices to move to the upside. You have wars. So let's say the dollar is currently strong and you're expecting prices to drop, right? But because of these inter-country relationships, a war might be affecting one country that is even making people scared to invest in the US. So they take this. So there's just a lot. So they're pulling these investments out and putting them in safe havens like gold and other currency and other pairs. So sometimes you might see the DXY moving to the upside and you still see this guy moving to the upside in a situation like that. So let's say the DXY is moving to the upside and gold is also moving to the upside. In a situation where the correlation is not really working, I'll wait for the DXY. So as the DXY tries to sell, this minor pullbacks is all that I need for gold to move again to the upside. It's not the best, but it's still going to give you those buys. But normally you want the DXY to drop and for gold to move to the upside when the correlation is working perfectly. The DXY should be selling and gold should be buying. It doesn't happen all the time, so sometimes you see it differently. But again, I hope we've understood something. Sorry, so this was NAS and this was not
I didn't understand. It has solved my problem. Now with this I can mark any chart, can take the levels.
Yeah. So look at these levels on NAS. I think this is the levels, like these are the levels I'm using currently. 15,000 to 20,000, 20,000 to 25. This should be the levels I'm using on NAS right now. So I have 15,000, I have 10,000. Yeah. So if you look at this other piece right here, let me study this. It didn't really come to the downside, but we're looking at a movement like this, 190 days. All you have to do is position yourself within this entire move and start capitalizing on the pullbacks on certain things. Yeah. And that's why. So once you have the levels, once you have these levels, you don't switch it. So if you step down to the 8-hour time frame, you're looking at the same level. But then the price action
down to 1 hour.
Yeah, down to 1 hour time frame, the levels remain the same because you have a bigger target where you're going to. So yeah. So if you're a business person and business is moving well, or let's say you've moved from 100,000 to 200,000. If business is not moving very well, are you going to drop from 200,000 to start operating at 10,000? No, you have to drop first to 100,000, which was your initial. You try to start again from that level. So you don't just flip from 200 to 10. That's why I keep the levels the same on all this time frame. So like we've done a lot today, almost 2 hours.
Yeah.
Okay, thank you so much.
Does it make sense?
Now I understand the rationale behind the color of the chart, which is
yeah. That's why I have my charts. I'm just looking at single colors. I'm not looking at buy and sells and buy. No, it's price. What's the price telling me? Yeah.
Understand?
Yeah.
Learned a lot today.
Okay. Yeah. Thank you.